Welcome and good afternoon. My name is Josh Woodvine. I'm the National Sales Manager here at North American. I'm joined along with one of our regional sales directors, Jonah Hardenbrook. We're going to
good afternoon, everybody.
Yeah, thanks, Jonah. We're going to keep it right at 30 minutes today. We're going to bring a lot of value, keep it to 30 minutes. For a couple of housekeeping items, we are in listen-only mode if you're an attendee. In the bottom middle of your screen, there's a Q&A box for questions. We are going to have a really jam-packed, very valuable half an hour today. And then your regional sales director will follow up with any questions that you have to be able to answer those one-on-one via email or a phone call. At the end of today's presentation, there will be a survey where we ask a couple questions. So again, we can provide relevant follow-up after the event. Today, we're going to cover two things, and we're extremely excited to talk about it. I'm going to be covering the accumulation sales positioning, really neat client-approved materials, some of the best pieces I've ever seen anyone in this industry put out, very effective materials. They're all client-approved. And then Jonah will be covering our VersaChoice, which is our top-selling #1 accumulation product here at North American. So on the first slide here, this is a really neat conversation starter. And again, everything you're going to see here is client approved and everything is very education based. This is a conversation that a lot of people start off with is because everyone you're working with that's a pre-retiree or a retiree has lived this. If you look coming out of the late 90s, everyone knows what happened with this, what we call the lost decade. You see the tech bubble burst after being up 106%. It took you 2 years to hit bottom, 49% slide over 2 years. It then took you 5 to 6 years to break even, and we had the housing crisis. At that point, it sold off 57%. And again, what a lot of people don't realize is the amount of time it takes you to hit bottom. 2 years on the last two downturns to hit bottom. And then after that, and this is the recent memory, this is what people really remember, especially your younger clients, they remember the last 12, 13 years. We've had a monster run up in the last 12 or 13 years. And this is really recent memory for a lot of people. And so this is a really neat conversation to tee up what someone's plan might be going forward. We're at an all-time market high, but clients have heard all-time market high, all-time market high, all-time market high so many times now that we are so numb to what that means until they see a chart like this and they realize this is phenomenal how high this market level is. We're very excited and happy, how this is done because our index annuities have been able to capture some of the upside in this last 12, 13 year run up. So we are excited about that, but this is a conversation where we need to maybe have a conversation around for a portion of your assets. Do you have the right balance between at risk, not at risk buckets of money? And for a portion of your money, do you think that locking in this level of gain and being in a principally protected bucket with some market linked interest to the upside going forward might make sense to you? And so it's all about creating the win-win. If we have a sell-off like we saw first quarter of last year, or we've seen in the past, if we have sell-offs like that, we've put a floor in, a 0% floor for a portion of their money. And so that's a win. Obviously, if there's a downturn, if it takes a year or two, we have a fixed account, we've got stuff. We're not at least losing any money to the clients. It's all principally protected. But if the market were to continue to do well for another 5, 10 years, we're extremely excited because we can capture some of that upside market linked interest. So on the next slide, this is a really neat progression to go into. If you ask your average client who's 60 to 70, 75 years old, how many bear markets you've lived through? Well, I know from my experience, I've heard a lot of people say, I think something happened in the 80s. I don't think the 90s ended very well. And that housing crisis in 08, that wasn't very good either. Well, the reality of it is if you're 70 years old, you've actually lived through 11 bear markets. That's kind of eye-opening for a lot of clients because they just haven't thought about it. We typically remember what's happened lately, and what's happened lately has looked very, very strong. So we put some really neat stats on here about the average bear market occurs every 5 years. We're 12, 13 years into the current bull run. The average decline is 39%. And this is this duration. This is what a lot of people don't focus on. Once you have the downturn, how long did it take you to actually hit bottom? The last two were actually closer to 2 years, but the average duration for a bear market's 1.5 years. After you hit the trough, after you hit the bottom, it then took you on average 5.2 years to actually break even from the previous peak. So that's a very powerful conversation starter about if we do experience some downside. This is historically some of the stats behind what's happened. On the next slide, this is one of the best pieces I've ever seen to visually display a concept that I guarantee everyone on this call has been talking about for a decade or two. This is an age-old concept that has never been visually displayed this well. I've been in all 50 states, traveled the entire country, been in a lot of different agent and advisors' offices, seen a lot of different ways how stuff like this is presented. And this idea of break-even loss is a conversation that sometimes we take people to math class and their eyes gloss over and they don't really know what we're trying to get across. We visually display a concept here that's very effective. Everyone on this call, we all know how math works. If someone loses 10%, 10% is not the corresponding return you need after that to get back to even. And so what I've seen through the years is people bust out the yellow legal pad. They put $100,000. Okay, if $100,000 loses 10%, we're at $90,000. If you get a 10% gain on $90,000, that's $9,000. You're at $99,000. To educate clients on, if you lose 10%, it does not take you only 10% to get back to even. Well, instead of trying to do that math on a yellow legal pad or on a whiteboard, what we're doing here is giving you that math all in one chart. And what I love about this is they can see visually exactly what you're trying to get across. They see the nice straight line on the left side of loss, but they see the exponential bell curve on the right of the further you are down, how much worse the math gets. And so we're not making any predictions of what's going to happen in the market. We're not doing anything like that. We're educating people on math. And so if you jump down to like a scenario of first quarter, second quarter last year, if someone was down 25, 30%, people don't realize the corresponding math. If you're down 30%, you need a 42.9% run up after that to break even from where you were at before the downturn. If you ask most people, how much did you lose in 08? They can usually almost to a penny or to a percentage tell you what they were down. What a lot of people don't realize is even if they didn't sell anything, again, this is if you didn't sell anything and you actually wrote it out. If you lose 45%, 81.9% is the corresponding return to break even after a 45% loss. This is a very good educational piece, just to educate people on the math of loss. And visually, this is displayed better than anything I've ever seen out there. On the next slide, at this point, we've talked about the last 20 years in the market. We've talked about bear markets. We've talked about break-even loss. Your average client might be sitting there thinking, I haven't really looked at this in a while. I do need something that's principally protected. And most people might be sitting there thinking, I'm going to run to the bank. That's what I've always done for safety and to protect my principal in the past. I'm going to run to the bank. What we did here is we put a really neat chart together looking at the average CD rates. If you look at the top left of this chart, you see some really nice CD rates, over 6.5%. Mid 2000s, you see a lot of 3 to low 5s, some really nice CD rates. But what we're showing is the way I like to say it is, did you get enough growth to matter? Did you get enough growth on a CD? Yes, it's principally protected, but did you get enough growth to offset things like taxes and inflation? And so what we do is we take the average CD rate, taxes, inflation, and then we show them what we're calling a real return after we account for taxes and inflation. Over the last 20 years, there were 4 years where your CD rate was high enough to actually have a positive real return after we accounted for taxes and inflation. So what we're showing you is, yes, you need to be principally protected with a portion of your money if that's one of your objectives, but not all principally protected buckets are created equal. And so on the next slide, we call this the risk spectrum piece. And this shows you really the whole financial world on one spectrum. That horizontal green line that just came up is our principal protection line. Everything above the line is going to have some risk to your principal. Everything below the line is principally protected. As we go from left to right, you're going to see more growth potential as you go up that line, perhaps. But to be principally protected, we are really identifying the things underneath the line. So your average client might have stuff above the line. They might have stuff below the line. They're going to most likely have money on each side of the line. What we're saying is the fixed index annuity is going to be the best solution for the principally protected vehicles that are out there. So if we go to the next slide, that's a pretty big statement. That's something that we can really, the home office is going to say, you might back us up out in the field with a statement like that, but we want to visually show a client how our statement there works. How does an indexed annuity work? And so what we show here is the reason why I like this presentation so much is we started with the last 20 years of the S&P. We've educated them on several things. And at this point, we're introducing the last 20 years and potentially a smoother way for a portion of their money that's principally protected and what that last 20 years could look like in an FIA. So I really, really like this chart. The light gray line is your S&P 500 line. The dark green line is the indexed annuity. And the three things we want anyone really to know once we come out of a presentation like this is, what does an annual reset look like? Every 12 months, we're going to have the ability to lock in their gains and then never go backwards after that. We're going to have that annual reset ability, and we want to show them how we can participate in some of the upside, but none of the downside. And we do that in this one chart. Again, you see the late 90s, you see the sell-off 2-year slide. Obviously, the index annuity went sideways. You see us participating in some of the upside, not all of it. Going forward, 08 happens. Again, we actually, in this Mark V index that we're showing here, it's an S&P index. There's actually years where the market went down and we saw small gains in this index. So this is a very neat index to have a conversation around. We will dive further into that Mark V here soon. But this is a really neat chart that gets me excited to present to really anyone. People we're meeting in the field, for you to present it to a potential client or a client. On the next slide, and again, to recap, I think we've had some questions come in. All of these materials are client approved. All of them can be emailed to you. All of them can be mailed to you physically. You can order, we have a standalone brochure that does all this in one brochure, or you can order the individual pages. So we really want to give you good client approved visual stuff that's really going to educate, your clients and people you're working with, and visually display age-old concepts in a really neat way. So with that, we've got our regional sales director, Jonah Hardenbrook, on the call, and he's going to be covering some VersaChoice information for us. I'm excited about this. We are selling a ton of accumulation business. Just to kind of share behind the scenes here, we're up to about 70 to 80% of our sales are accumulation focused. VersaChoice is by far our #1 seller. We sell a lot of this. So with that, Jonah, take it away.
Yeah, thanks, Josh. Appreciate the handoff there. One thing I did want to mention, and you kind of covered where they can find a lot of those materials that you covered, and you did a really great job of covering those pieces. So thank you for that. Some of those pieces are available also in a fillable format where you as a rep can actually put in your information, your contact information, your name, your address, your phone number, and use them that way as well. So those are great pieces. And if you haven't had a chance to check them out or take a closer look, I definitely recommend doing so. But what I want to talk about in particular is North American's best-selling indexed annuity. It is the VersaChoice 10. And if we move on to the next slide, I think you're going to see here one of the reasons why this product resonates so well with the field. It has a very simple design. There's not a lot of moving parts to it. And as Josh had mentioned, there's really 3 basic components that I want you guys to walk away from knowing about this product. It is for growth and accumulation. And so when you're looking at growth and accumulation, there's really 3 things that matter, in my opinion. Bonus, whether or not there is a bonus, and if there is, what that is. If there's not, what the rates look like, and liquidity aspect. And so those are the 3 things that I'm going to spend a little bit of time on today. First, let's get the nuts and bolts out of the way. I talk about how simple it is. You can see on here, it is a 10-year indexed annuity. We can write it up through age 79. and it is a modified single premium contract, which means that they can add money to it in the first contract year. However, after that first anniversary, they're not going to be able to add any additional deposits to it. You can see there that the minimum premium on it is $20,000. It is banded, and you'll see that in the next couple of slides. When we look at the rates, you can see that 75,000 or more in premium is actually going to have a little bit better rates than the less than 75,000. So again, on the next slide, these are those three components that I'd mentioned that I really want everybody to take away from this conversation today. Bonus, performance, and liquidity. Let's get the bonus aspect out of the way. There is not a premium bonus on this, but that's a really good thing in my opinion, because what we've done is we put that money back into the rates. And I've worked for North American for the last 16, almost 17 years now. And one of the things I love about North American's annuity products is the ability for clients to diversify. They're not forced into one or two particular allocations, or even 4 or 5 allocations. You can see here we've got 11 different allocation options for that client to choose between. And with the rate increase that we had in May, there are 9 uncapped strategies that are illustrating anywhere from nearly 4% to as much as 9.5%. We simplified, in my opinion, what these strategies are, and that we're using S&P, family, and Fidelity indexing options. Those are the ones to choose from. What's great about that is your clients may not have heard of North American. It's not necessarily the household name, and that's why we have you as the agent there to tell that story. But they have no doubt heard of S&P and Fidelity. And Josh, correct me if I'm wrong, what, 1 in 4 households in America have Fidelity as some part of their retirement plan? And so, you know, they've heard of Fidelity. Mm-hmm. And then the liquidity aspect of it, I want to touch on that as well. And we're going to dive into a little bit more of that when we talk about our optional enhanced liquidity benefit rider. But the base level liquidity within the product is 10%. Now, that's relatively commonplace, but one thing that sets this apart from a lot of the other products in the marketplace today, as you can see there, is that 10% penalty-free withdrawal is available each year starting in the first contract year. They don't have to wait a year before they take out or have the ability to take out a penalty-free withdrawal. I'm going to actually toss it back to Josh real quick. He's going to talk a little bit more about the indexing options, you know, the S&P and the Fidelity, some of those alternative strategies that we've introduced on this product.
Thanks, Jonah. Yeah, we are very excited about the performance potential in a product like this. To Jonah's point, we really want to stick with you know, household names with S&P and Fidelity. I will give you the conversation, kind of how we train people to have this conversation with clients with our 2 most popular indexes. They're very, very effective conversations and can really, I think, very quickly in 30 to 60 seconds, someone can understand exactly how these indexes work. And to Jonah's point, these are the engines behind our product. This is where we're driving that performance. And we're really excited to talk about these 2 indexes. The S&P Mark V is an S&P index. So S&P is taking their S&P 500, adding a bond index and a gold index all into one. So MARK stands for multi-asset risk control. So, okay, multiple assets, S&P 500, bonds, and gold. They can move between those 3 buckets all in one index for the client. With that, I just completely explained Mark V. That's why it resonates so well, is it's a diversified multiple asset index, and it's extremely easy to explain to a client, and it's things that they recognize, S&P 500, gold, and bonds. So that's a really neat conversation to have. If we start there, the Fidelity is a very natural transition to have the conversation with. Fidelity approached us with an exclusive index. They are privately held, we are privately held. We really thought this was a neat partnership, and they showed us this index. And what Fidelity is famous for is what's called factor-based investing, which is really just a fancy way of saying they've identified 55 different ways they can characterize, or lenses that they can look at any stock through. So they have 55 different factors they've developed over the course of their long tenure as a company. But what they've done here is they've actually taken 6 different ETFs and bundle them all into one index for us. Those individual ETFs are all based on different factors, and they look at different things within the stock. So if you look at your screen here, you actually see what those are. They look at momentum stocks, quality, low volatility, size, value, and dividend yield. About 45% is sitting in the dividend side, and then the rest of it's evenly split out between those others. So again, it's a really neat index because you have 6 different Fidelity ETFs, and it's a really neat diversification story. All 6 ETFs bundled into one index here at North American. So that's kind of some of the insight behind the growth in our product. Mark V and Fidelity being 2 of our most utilized index options on there. With that, I'll send it back over to Jonah so you can cover some of the liquidity.
Yeah, a couple of things that I wanted to share before we get into the liquidity aspect of it is the rate spotlight. And this is one of my favorite pieces that we have when it comes to talking about this product. It is available on our website, and it's like looking at an illustration without having to go out and run an illustration. And I mentioned, a few slides ago that right now we're looking at illustrated interest between 4 to 9.5%. And you can see here where that is coming from. With S&P Mark V, with Fidelity, there's not only annual point-to-point, but also 2-year point-to-point strategies that the client can choose between. We'd introduced as well these enhanced participation rate strategies that, for a slight strategy charge, are going to offer higher participation rates. Participation rates as high as 190% right now. And so you have, from an illustrative perspective, you have an opportunity to place that money into one bucket to be illustrated, or split this out again 11 different ways. If you have any questions on this, or if you need help with an illustration, certainly let us know. But this is a nice tool. That's a snapshot that you can use to get an idea as to where these different indices are illustrating at. Let's talk about the enhanced liquidity benefit rider. This is something that's optional. It's not automatically included. It's not something that is required, but it is something that is going to set this product apart from anything else in the competition. And it is going to offer unparalleled liquidity for your clients. I'd already mentioned that it's a standard 10% penalty-free withdrawal. If they add on this, and I'll shorten it up to this ELB rider, if they add that on for a small fee of 60 basis points per year, it's going to provide them with 4 additional liquidity benefits. And I'm going to walk through these 4. I'm going to start on the left-hand side with those first 2, and then work my way over towards the right. The first one is enhanced penalty-free withdrawals. And what that means is, if your client does not take out that 10% penalty-free withdrawal when it's available, the following year they could take out up to 20%. And that is the max on it. If they take out that 20%, it reverts back to 10 the following year, so on and so forth. But if you think about that, if they don't take out that 10% penalty-free withdrawal in year 1, as soon as year 2, they could access 20% of their account value. And that's really strong. That's a really good peace of mind for clients. Below that is the return of premium. And this is a great feature, again, peace of mind. It's not something that I think is going to be necessarily widely utilized, but from a psychological standpoint, it really gives clients, like I said, a little bit more peace of mind. And the way that that's going to work is, as long as this policy is enforced for at least 3 contract years, if they were to surrender the policy in year 4 or beyond, they're guaranteed to get back at least the premium that they put into it. Now, that would be less, of course, any withdrawals that they take, and less any strategy fees from those allocation options we looked at. We don't assess the 60 basis point rider fee to it. But simply put, if their needs change, if something happens down the road and they need full access to that money, they're going to be able to get back at least the premium that they put into it, or the surrender value, whichever is greater. Now, those 2 benefits are automatically included with this rider, regardless of the client's health. The last 2 benefits that you see there on the right-hand side are ADL based. And the way that that's going to work is, anytime after the policy is issued, if your client is unable to complete 2 of 6 activities of daily living, they are going to have additional access to their monies. That first one is an ADL-based surrender charge waiver. That is one of the nice things about that feature is there's not a waiting period on that. That is available anytime after the policy is issued. So if we issue that contract today and the client's able to complete all 6 ADLs today, but a month or 2 months, something happens and they're not, they can enact that benefit and they would have full liquidity. We waive surrender penalties, we waive market value adjustment, that contract becomes completely liquid to them. Now that last payout in the lower right-hand corner, that's an ADL-based payout benefit. And what that is that's a payout of an enhanced percentage of their account value. And you can see the grid there at the bottom. Starting in year 3, it's going to be 110% of their account value up to 125% of their account value in year 6. And that's going to be the max on it. But again, if they're unable to complete 2 of 6 activities of daily living and they turn on that benefit, if we're 6 years into the contract, we're going to pay them 125% of their account value over 5 years. With this product, or with this rider rather, there's not any necessarily underwriting per se. There's simply one question that's asked on the disclosure form. If they elect that rider, it's going to ask, are they able to complete all 6 ADLs at the time of issue? If they are, they can add the rider on. They get all 4 of these benefits. If they are not able to complete all of the all 6 ADLs at the time of issue, they can still add the rider, and they're going to still have access to those 2 benefits that we talked about on the left, those enhanced penalty-free withdrawals and the return of premium. I would say about 30% of the applications that come in have the ELB rider attached to it. So we are, when this product, when we're talking about it, when it's being more widely utilized, it is for that growth and accumulation aspect of it. But this rider, for those that need it, again, it's going to set the product and set us as a company apart from anything else that's out there right now in the marketplace. I did see there was, one question that had come in, and I'll go ahead and throw an answer out there to everybody, is if you've not sold this product before, or if it's been, prior to May of 2020 that you'd sold this product, there is a possibility that you'll need to complete the product training, and that could be done through the Reg Ed platform. And again, if you have any questions on that, certainly let us know. Josh, anything to add on the product as we wrap things up for the afternoon?
No, thank you so much, Jonah. I mean, that was a really, really nice overview for everyone on the call. I mean, the reality is 2/3 of the sales are coming in very simple. 10-year product, no bonus, really attractive rate, illustrating 4 to 9.5% net returns to a client, 10% access in the first year. 2/3 of the sales are coming in that simply, and all of it's powered by S&P and Fidelity. And then the other third is coming in with this ELB rider that Jonah just covered extremely well. So that's kind of just, again, a look behind the scenes here on kind of what our utilization is. And we're very excited about this product because it is a very strong accumulation and growth story. And if you need the additional liquidity, you can add that ELB for a very, very low cost. So thank you for joining us today. If there's a lot of questions that came in, the regional sales directors will be reaching out to people in their region, answering any questions. We'll be calling and emailing here very soon. Again, all the materials that we covered, the rate spotlight, all the sales positioning stuff, we can get that emailed and or physically mailed out to you, give you nice glossy versions of it. We're very excited about additional conversations around this because we are extremely confident that this will fill a need in your business and in your client's portfolio. So we're very excited to talk about this product with you, and be looking forward to talking soon. Thank you. And with that, have a great afternoon.
Thanks, everybody.